Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P that has been in free fall, coming back down to retest the June lows after breaking down very important technical structures, both this uptrend line from the two lows here that we had in June and July, and this price channel that a lot of people claim is a bear flag and could take the market down to 3,400 points, back to the pre-pandemic highs. Now, of course, anybody can have an opinion on the market. That's the easy part. We're going to try and dive into the data, into the charts, into the odds, and try and figure out where this S&P capitulation event, because I do think that's what this is, where that's going to end. If you are interested in following these crazy markets with us, don't forget to smash that subscribe button if you haven't already, and smash that like button as hard as you can if you enjoyed this episode. It really does help us out. Now, without further ado, let's get right into it. I want to start off by quickly taking a look at a couple of charts from this article that we posted on this SP 500 update that we posted on Monday pre-market hours, where we took a look at a few different characteristics of market capitulation, trying to assess if the market really is in capitulation, and if it is, where should we expect it to end. Of course, that's a very complicated question, as we're about to cover in this video. Nonetheless, there's quite a lot of information that the data is giving us. So first of all, the reason behind the sell-off, let's start with that, is none other than the Fed, right? A lot of people are saying that weak earnings are beginning to get discounted. I really don't think that's the case, because the market essentially is being driven by yields, by bond yields. This is the Fed funds curve, so market expectations of the Fed funds rate before and after the meeting, right? Pre-meeting, you can see expectations were that rates were going to peak at around 4.5. By 2025, they'd be at around 3.5. After the meeting, it was significantly higher, leading to a very aggressive repricing in stocks and also in bonds, right? Bonds went parabolic here. Both the bond and the stock market repriced very aggressively following that meeting. I always find it very amusing to see the market pricing in things to 2025 based on what the Fed is saying, as if the Fed has ever been accurate at predicting its own monetary policy. I think that's rarely been the case, but nonetheless, that is what is happening. And this is the chart that I really wanted to get to in this video, and that is the S&P 500 breadth. More specifically, the percentage of stocks within the S&P that are trading above their 50-day moving average, right? So it tells you how many stocks are trending down versus how many stocks are trending up. Look at the reading we had right here on this last move down. Very low levels. This is a chart that goes back to 1998 or even 1997. So taking into account two vicious bear markets. Even throughout this data set, you have a handful of readings where market breadth was this slow. And so I know a lot of people don't agree with this statement, but this is, for us, a sign of market capitulation. When you have almost zero stocks trending up, it's a sign that almost all stocks are being hated by the market, that there's aggressive selling pressure, and that essentially you're in capitulation. And you can see the last few times that we had this, 2018, 2015 right here, 2011, major buying opportunities throughout this bull run, and then around the 2008 bottom and the 2003 bear market bottom. Now, you're probably wondering, where's the catch right now? Nothing is perfect. You can always find problems if you dig a little bit deeper, and we're going to discuss that in just a second. But if you look at the pure data, right, looking at the returns, looking out 6 to 12 months from these types of readings, only 2 out of the 17 signals led to negative 6-month returns. And I show that data right here. 15 positive trades out of 17 with an average return of 16%. Looking out 6 months. Those are good gains, right? Those are very good gains in terms of average returns. The problem with these kinds of readings when the market is very oversold is that nobody wants to believe this signal. Things look too bad. Nobody can find a reason to get bullish on the market. If you think about how the market works, how it's a constant, rapidly discounting machine, it makes sense that things look bad at market bottom. All of these bottoms, all of them, a lot of people, a lot of investors, a lot of experts were saying that the markets were supposed to head much lower, or that there was a lot more runway for the market to continue capitulating. That's because most people think they're smarter than the data, but the data is compelling here. 15 out of 17 positive signals looking out 6 months. When I see this type of data, it seems pretty convincing. I want to take the opposite side of the trade, but you'll quickly notice right here, the max risk is 22% downside. And that's going to bring me on to my next point. But before I do so, don't forget to smash that like button as hard as you possibly can. These videos take a lot of effort, a lot of time to try and make it as digestible for you guys and as accessible for a maximum number of people. So if you want to help Game of Trades out to reach a maximum number of investors, be sure to smash that like button without breaking your computer screen. So this is what the data is saying. At least from this indicator, it seems that the market is in capitulation. There are other signals that are showing that the market is not in capitulation, and the volatility, the VIX, is one of those, which was also discussed in this SP 500 update. And when we zoom into the short-term technicals on this 8-hour chart of the SP 500, we are in a position where we've had a pretty intense downtrend. We're very oversold. We had an oversold reading on the RSI here, very oversold. And we now have the price action making divergence, bullish divergence between the price going lower, the RSI going higher. So technically, this is a bullish setup and would be confirmed by a breakout above this downtrend line and see a nice little bounce here. Potentially, if we're looking for target resistance levels, we have a nice zone of resistance around this 3,800, 3,900 point level. How much farther we go from there would depend on the Fed, it would depend on inflation, it would depend on the bond market, which of course we cover extensively every week on gameoftrades.net. But the problem with these capitulation events, and this is the same indicator, but we're gonna zoom in a little bit onto some particular episodes. For example, right here in 2020, you can see that the breadth hit oversold right here, but the market just kept on capitulating again and again, and the market continued to drop from around 3,000 points all the way down to 2,200 points. You know, that's obviously a moment where if you were sitting right here in March 2020, you would have regretted buying the dip on that first oversold reading, right? So that's something to keep in mind, right? Because when you have this type of market price action where, right, capitulation event, that's when unpredictability, uncertainty in the market, volatility goes through the roof. And so essentially you don't know where it's going to end. You don't know. Nobody knows during a capitulation event where the market is going to bottom. 2018, for example, here you had an oversold reading. You had a handful of oversold readings here near the bottom, and the market, continued on capitulating for a few days. So yes, now we know with hindsight that this move down was a great moment to be buying stock. This capitulation event was a great opportunity to take advantage of. But the point I'm trying to make is it's not a perfect timing indicator. You could have more capitulation after that. We had the same reading back here in June of 2022. And we covered that on the website right here in June of 2022. In this article right here, June 16th, we posted a tactical strategy update for the stock market, and we discussed this exact same signal where we were at capitulation levels not seen since 2020 and 2009 before that, which were, in hindsight, two of the most attractive buying opportunities of the last 2 decades. And here we are at the same levels again. But was it an ideal entry to time the beginning of a major new bull run? No, obviously not. We're back to the same level now. Did it lead to an incredibly profitable buy entry with an 18% run up in the weeks after? Absolutely. Where you could have booked some profits as the markets were overbought and at resistance. Did it also reduce your downside risk massively? Yes. To me, this is not rocket science. I don't think of myself as a stock market genius, but I do believe that if you're watching the right indicators at the right time and you have an objective mind and you're seeing the odds very clearly as they appear, you can be very successful in the market. Our mission at Game of Trades is to make this data and the research process that we have that really gives an edge on the market We try to make it as accessible to individual investors as possible in terms of our ability, but it's also to make your life easier in terms of understanding it, putting all the information together. We have summary videos of the articles, summary bullet points of the articles, conclusions at the end of the article, buy and sell ratings for all the key assets that we're currently looking at based on all the research that we've made over the past couple of months. So if you think our service is something you'd find helpful, you can click on the link down below and check out our website, test out the free trial, test out our service, join and participate in the community. We'll make sure that you don't regret it. Now, quickly, that's something that you have to keep in mind if you choose to take advantage of this type of signal. It depends on whether you want to be stepping in aggressively during a capitulation event, which has led to some of the largest gains in history and has marked some of the big bottoms throughout this bull run. Or do you want to wait for a confirmation that the trend is switching and that we are beginning a new bull run, which would increase your accuracy, right? It would increase the accuracy of your trade, but it would probably reduce your potential reward, because in that case, what you're essentially looking for is a breadth thrust. And a breadth thrust comes when the breadth recovers off very low levels, like we had right here in April of 2020. That was a breadth thrust confirming that we had a significant change in market behavior. That was followed by a 60% run on the SP 500. And same thing here in 2018. We had a breadth thrust in 2019 that was followed by a 30% run on the S&P. So that really depends on your trading style. Do you want to wait for confirmation, reducing your potential reward? Because by the time you do get confirmation, the market will be higher. That's for sure. That's inevitable. But you avoid the tail risk and having to suffer for potentially this type of period where you buy in slightly too early, but the market covers so much ground so quickly that it looks that you really bought very early when it comes to the price action. So you can't have everything. There's accuracy, there's risks, there's reward, and you're going to have to make some choices somewhere. So I hope you guys enjoyed this episode. If you did, don't forget to smash that like button as hard as you can and click on that subscribe button. Now, in the meantime, I wish you good luck on your trading and see you next time.